Okay, so the other topic that's covered kind of in the chapter is liabilities that are based on estimates. Okay, so what are some, so again, some liabilities, you don't know the exact dollar amount. Okay, so when you borrow from a bank or you have an account payable for inventory you bought, you know the exact amount you owe. Some liabilities, you don't know that. Okay, you have to estimate that. It's similar to what we did with accounts receivable and estimating how much we would have to write off. What was our allowance for bad debt, right? This is a similar thing. What are some examples? A bonus plan. Bonuses are based on future sales results, so you don't know exactly how much bonus you're gonna have to pay, or how much is accruing over the year, because you don't know the exact amount you're gonna have in sales. Vacation, because you don't know how much vacation time employees are actually going to take. You're paying them and you're allocating vacation time, but how much they actually take, you don't know. Um, Health and pension. So this is all based on future deaths, when a person is actually going to die. Healthcare costs. How much is it going to how much is it going to take to put someone in the hospital for a week, 20 years from now, right? We don't, you can't, it's going to be based on some estimate. You don't know what that actual number is. Um, and then warranty. Okay, you don't know, you have some sense of how many of your products will go bad, but you don't know the exact amount. Okay, so all of these are examples of liabilities that are real, but you just don't know the exact dollar amount because it's based on some unknowable future event. And the best you can do is use estimates and some methodology to estimate what these things are going to be. So this is a question in the homework and in the book. It's not quite based on an estimate. It's more algebra. Okay, so I'm just going to put this up here. Um, See if you can figure it out. I'll give you a hint. There's multiple, like you probably learned this in Algebra 2 trig, where you have uh, two different variables and two equations, and you got to solve. Okay, so that's the hint I'll give you. See if you can figure out what it is. Okay, so you're gonna have to set up. There's two unknown variables in here, but you'll have two equations that you can also set up, and that way you'll be able to solve for both those variables. Okay, so that's the hint I'll give. See if you can figure it out. So there's two equations. Okay, 5% of our net income is going to be the bonus. So the bonus equals 5% times NI. Okay, there's two variables and only one equation so far. So we can't solve this yet. Okay, we need another equation. And what we can do is look at this second statement. 315 minus the bonus equals net income. Does everyone agree with these two? I've just translated what those words said into two equations. Does it make sense? Okay, so now we have two equations and two unknowns, so we can solve. Okay, so what I could do is substitute. Uh, I already have b written as a function of net income here, so I can just substitute it here. I can do 315 minus 0.05 times net income equals net income. And then I can 315 equals net income plus 0.05 net income. I just added net income to both sides. It canceled with this. And then I factor out net income. So 315 equals net income times 1 plus 0.05. And then take this and I can do 315k divided by 1 point plus 0.05 equals net income. So what is this equal to? Let's see. 300 equals net income. Okay. So now if I want to know what the bonus is, I can just go back to my original equation here. Bonus equals 5% times net income. So 300K times 5% equals 15K. So yes, you got to the right number. Actually, I think this one is probably written in a nicer manner. So you can take a picture of this if you want to just remember. Okay, and this would be, of course, the journal entry. Okay. The hard part was calculating this amount. That's really the difficulty. After that, you know the bonus expense is this, and you're gonna have to pay it out to them. Okay, next one. Company made sales on account of 50,000. Cost of goods sold is 35,000. So this is the revenue. This is the cost of goods sold. Subject to product warranties. Okay, so this is on June 10th. And you estimate that the warranty will be 3% of sales. So basically, what is the adjusting entry? Let's say December 31st. What's the journal entry for warranty? And I'll give you a hint, warranty expense. Okay, because again, some of these sales are going to come back. They're going to get returned because the warranty. Are you going to have to? There's going to be some expense associated. Okay, so you want to make sure that you're matching the cost of the warranty with the revenue because they should be in the same period. Okay, so there will be an adjusting entry. So think about what that's going to be. So this would have been the journal entry, and then it's 3% of the sale, like the revenue. Yeah. So actually, this should have been December 31st. You're probably going to take this um, as an adjusting entry. Okay. Um, yeah. The point is that you're going to have some expense for warranty, and you're going to have some liability that's going to be kind of as you pay out warranties. So, like, let's say in the next year you pay a warranty like claim. What's going to be the journal entry for that? Should we take an expense again? Because we have to pay the person out cash. Let's say it's like a return, right? The thing is defective. So you're gonna have cash. Let's say it was $100 return, the item. So what should I debit? Should I do warranty expense here? No, what should I do? Exactly. So we'll use this estimated warranty payable as again a little piggy bank. Okay. And it's possible that this credit balance gets used up and becomes a debit balance because we have more warranty uh, claims than we estimated. And you'll have to fix that. In the next period, you'll have to take a larger expense for warranty to make up for that. But remember, I told you that story of Tesla where they were selling more cars, but they were not taking a larger warranty expense. And they were doing that for the short term because they needed to be included in the S&P 500 and they needed to show a positive net income, and they barely did during those quarters. Once they were in the index, they're going to pay the price because there will be more warranties that come in because they're just selling more cars, but they'll just take a larger expense later because the goal at that time was just to show positive net income for those few quarters because they needed that to get into the S&P 500. Okay, but it was all deferred. It's not like they were getting a free lunch. They were going to have to make up for it later by having lower net income. In this case, instead of uh, paying out cash, we just replaced the item, right? So with a warranty claim, it could have been cash where you just refund the customer with money, or you would just replace the item. And that would also be a credit to inventory because you're kind of giving up this inventory item to the customer to replace the one that they made a claim on. Okay, so you have to read how you settled the warranty claim. Okay, it could have been with cash or with a replacement, and you have to credit accordingly.